Hello guys and welcome back. I hope you people can hear me now. So I will try to cover as many questions as possible today. So without wasting a time, let's start our question of the day. And we are starting with the OAP question. The board of OAP company has decided to limit investment funds to $10 million for the next year and is preparing its capital budget. The company is considering 5 projects as follows. All 5 projects have a project life of 4 years. Project A, B, and C are divisible projects. We will discuss in a while what is meant by a divisible project. Project B and D are mutually exclusive. That means we can have either B or D. We can't have both the projects together. And all net present values are in nominal terms, after tax terms. Project E is strategically important project which the board of OAP company have decided must be undertaken. So that means we have to undertake this project irrespective of its NPV or acceptability from any other aspect. Sales volume, selling price, variable cost, fixed costs. These forecasts are before taking account of selling price inflation of 5% and variable cost 6% and fixed cost inflation of 3.5%. The fixed costs are incremental fixed costs which are associated with project E. At the end of 4 years, machinery from the project will be sold for scrap value of $400,000. Tax allowable depreciation on initial investment cost of project E is available on 25% reducing balance basis, and OAP company pays corporation tax 28% per year, 1 year in area. Now this is a question where the tax is paid in arrears, and a balancing charge is allowable at the end of 4th year of operation. And the after-tax cost of capital is 13%. Calculate nominal after-tax net present value of project E and comment on the financial acceptability of this project. Okay. So let's do the calculation now. Let me make some space. Okay, this is a 4 years project, so and we must report the figures in thousands. 0, 1, 2, 3, 4, and we should have a fifth year column because of the tax being paid in arrears. So first sales will be 12,000 for the first year. Price is 450, and the inflation rate is 5% for the selling price. So 1.05 raised to the power 12,000 into 450 into 1 plus 5% raised to the power 1. 5670. And let's copy and paste it. So let me reduce the decimal places. And now let's change the sales and prices. So the sales volume will be 13,000 and the price is going to be 475. Then for the third year, the sales volume will be 10,000 and the price is going to be 500. And for the last year, sales volume will be 10,000, whereas the price is going to be 570. So done with the sales. Now let's write variable costs for each year. So it's 12,000 for the first year, the volume, and the price is 260. And inflation rate for the variable cost is 6%. Here we go. And connect it with the let's remove the decimal places. And for the second year, the sales volume will be 13,000. The variable cost is also going to change. That will be 280, and no need to change the rest. For the third year, the sales volume will be 10. The variable cost is going to be 295. And for the last year, sales volume will be 10,000, whereas the variable cost will be 320. No need to change anything else. Then comes fixed costs. Fixed costs are 750 each year. So 750, and it should be inflated at the rate of 3.5%. So 1 plus 3.5% raised to the power 1 for the first year. And then thereafter should be just simply copied. So that's incremental fixed cost for every year with inflation. So I think we don't have any other tax allowable expenditure that involves cash flow. So we can simply net off these figures. Pre-tax cash flows. After pre-tax tax cash flows, we should incorporate tax rate. 30%, I don't know. Let me check the requirement. It's 30% of what? No, the tax rate is 28%. The tax rate is 28%. So as you all know that the tax was to be paid in arrears. So in case the tax was paid in the same year, this is what how we should have treated. But since the tax was in arrears, so now we should do one thing. We should just take this figure and take 28% of this figure, but we should be showing it in the second column, the second year column, because of the arrears. And then we should stretch it to 5 years. And that's how it should look like. Then comes tax benefit on capital allowance. Okay, for the tax benefit, I'm giving you 3 minutes time. And I want you people to calculate the tax benefit on capital allowance using the shortcut that I mentioned in last day. So on the last day session. Okay, let just take 3 minutes and calculate tax benefit on capital allowance. So few people want to take screenshot of the question. I've just displayed part of the question. Just take a screenshot of this part and I will drag it down so that you can take screenshot of the second part as well. So now go ahead and calculate tax benefit on capital allowance. Okay, now let me calculate it using a shortcut now. I'll just show you how to calculate in the shortest way. What's the cost of the asset? It's 5 million, right? And the allowable depreciation for tax purpose is 25% on reducing balance basis. So just look at the shortcut now. Since the tax will be in arrears, so we should start showing the benefit from year 2 onwards. So asset's value is 5 million, and we should take 25% of this. So 1250 will be the tax allowable depreciation. So what the tax authorities will do is they will reduce our tax liability by 1250, and hence they won't charge us tax on this amount. So the tax on this amount which will be saved will be equal to 28%, and that's 350. So this is the reduction in our tax liability because of the tax depreciation, and this must be shown as tax benefit, and that is because of this asset being purchased. Now the shortcut is, since the value of the asset is going to reduce by 25% every year, therefore the tax benefit will also reduce at the same rate. Okay, I've got a request to repeat this. The assets cost is 5 million. The tax authorities will allow us to charge 25% tax depreciation on this amount. So if you take 25% of this amount, that will be the tax depreciation. This amount will be deducted from our taxable income, and then a tax of 28% will be charged, which means that we will be saving a tax of 28% on this amount, which is equal to 350. Ashar, I have shown the working. This is a working. Don't you think it's a working? This formula itself is a working. I have taken the cost of the asset. I have multiplied it with the tax depreciation rate, and then I have multiplied it with the tax rate. So this was for the first year, right? Now, since every year the value of the asset will be depreciating at 25%, the tax benefit will also be depreciating at the same rate. So for the next year, the tax depreciation will be 25% less. Sorry, the tax benefit will be 25% less than the previous year's tax benefit. So all I have to do is to take 75% of this figure as the tax benefit for the next year. So I'll just take 75% of this figure, and this will give me the tax benefit for the next year as well. Just reduce it by 25%, and that's $262.5. That's for the second year. So you don't have to do anything, just reduce it by 25%, because every year the value of the asset is going down by 25%, and it will also reduce the tax benefit by 25%. For the next year, we should take 75% of this figure, and it is going to be 196.875. Now see how easy it is to calculate the tax benefit using this shortcut. We are done with 3 years calculation. Is it clear? so that I move to the last year. Muhammad Nadeem, this is a reducing balance method. This is the reducing balance method. In the straight line method, every year's tax benefit will be same. For the year 2, we just need to take 75% of the previous year. And in the next year, we will again take 75% of the previous year. This is what you have to do. Similarly, we will be doing it for the third year. We should take 75% of the previous year figure. Right? So for your clarity, I'll just do the other working as well, so that you can compare that we have ended up with the same values. The cost of the asset is 5,000. In the first year, capital allowance, that is the tax depreciation, will be 25% of this figure. And the tax benefit will be 28%. And that is going to be 28% of 1250. It's 350. We've shown it here, right? So I'm just doing this for your clarification. We don't need this one. Okay, for the at the end of the first year, the WDV will be value of the asset minus depreciation, 3750. For the second year, the capital allowance will be 25% of the WDV, because it's a reducing balance method. It's going to be 9375. The tax rate will be the same, and the tax benefit will be 28% of this WDV. I think I have made a mistake, but it's okay. Sorry. Yes, it's okay. So see, it's 262, and I've written 262 here as well. Now that's the second year. Now for the third year, at the end of the second year, the WDV will be 3750 plus capital allowance, so 2812. Again, we have to calculate capital allowance for the third year, which will be equal to the WDV at the end of the second year into 25%. 703, same tax rate, and same tax rate should be multiplied with the capital allowance to find out the tax benefit. See, it's the same, 196.875. So see how lengthy it is to do it in this way, and how easy it was doing it that way. So it will save a lot of time. Yes, Abdul Rahman, you can definitely do it in the same way, because I haven't skipped any step. I haven't skipped any step. If the examiner wants to know how I have done it, that's how he can know. See, he can easily find out how I have calculated this figure. We should not skip any step. We should do it properly and show all the working. Yes. All you people have to do is to show the working, that how you have arrived at a certain figure. And I have shown that working. The examiner can clearly see that this is what I have done. Now for the last year, now this is very important. For the last year, first we need to find out WDV, that is the remaining value of the asset, which is still to be allowed as depreciation. This is it, 2109.375. Now this is the last year of the asset, and after this last year there will be no project, and hence we won't be getting any tax benefit. So whatever tax benefit is left will be allowed in this last year. In the last year, what we have to do is we have to subtract the scrap value, because the scrap value is something that we will be receiving back from our assets value. So don't expect the tax authorities to be giving us this scrap value as tax benefit. So it should be subtracted from the last year's WDV, and the scrap value was 400,000. So we should subtract 400 from the last year WDV. And this figure is called balancing allowance. The whole amount will now be allowed as an expense. And that is called balancing allowance because this is the remaining value of the asset which should be allowed as expense for the last year. And the tax benefit will be allowed on this figure. If there is no scrap value, definitely we should not be subtracting anything. And this last year WDV will be considered as balancing allowance. So it's 478.625. That's the last year tax benefit. But I'm not using this method. But I'll show you how I can still continue with my shortcut. Just look at this shortcut. I may not repeat it. So I want you people to watch it and understand it. I will do it very slowly, but I need your concentration. The shortcut for calculating this figure will be, just look at this. We just need to pick the cost of the asset, which is 5 million. And you know that for 3 years, this value is going to depreciate at a rate of 25%. So in order to get the depreciated value or WDV after the end of first year, we need to multiply it by 75%. If we multiply it by 75%, it will give us the WDV after first year. Just look at it, 3750. That's the first year's WDV. Okay, we should multiply it by 75% again. If we do it, it will give us the WDV after the end of the second year, 2812.5. Here we go. That's the second year's WDV. If we multiply it by 75% again, it will give us the WDV after third year. And thereafter, we should subtract the scrap value. So if I subtract scrap value from this figure, which is 400, it will give me the balancing allowance figure, and that's 1709.375. And then we should multiply it with the tax rate. Multiply it with the tax rate, 28%, and we will reach to our tax benefit, 478.625. Here we go, 478.625. So we don't need to do all these. That's the final answer, but we can further reduce it. Instead of multiplying something by 75% 3 times, we can just take the power 3 and just write it once. So I'm just removing 75% that I have done twice. I'll just take this 75% and I'll just take power of this as 3 because I have to do it thrice. And I'll reach to the same answer. So that's the shortcut of calculating tax benefit on capital allowance. So just for a quick feedback from 1 to 5, how much did you people get it? Sankat, better not to write VC and FC. It might confuse the examiner. Though there's no restriction, but you should not confuse the examiner, and you should not take any risk of using any abbreviation that may be confused, and the examiner may not understand what you have actually done. Yes, this method is acceptable. Every method is acceptable if it makes sense, if it leads to right answer, and you have shown working of how you have calculated the figure. In case of the advanced tax, we should have started from year 0. That's it. That would have been the only difference. Instead of starting the first tax benefit from second year, we should have shown it from year 0 in case the tax was paid in advance. Okay, so I'm just removing all this stuff. That was just for your understanding. So we're done with the tax benefit. We don't have any working capital, right? And we don't have any other cash flow except for scrap value and initial investment. So let me write scrap value, which is 400 and should be shown at the end of year 4, and the initial investment, which is 5 million, and that's it. So let us net of all cash flows. These are net cash flows now. And now let's calculate discount factors using 13% rate. And again, we can use the formula 1 plus 13% raised to the power minus and link it with the years. Okay, and let's copy and paste all values, and better to reduce it to 3 decimal places. And now calculate present values. It'll be 5,000 and copy paste formula. And so net present value and so that's NPV, and it's negative. So should we accept the project on financial ground or not? Absolutely not, because it's resulting in a negative NPV of $46,000. But what should we say after but? But the board has decided that it has to undertake this project irrespective of its financial acceptability. So we can we can have a comment that on financial ground this project is not acceptable, but since the board members have already decided about the fate of this project, therefore it should be undertaken. Koli, since the question uh, has clearly mentioned that the board has decided and they have a reason, and the reason was to be competitive in the market, they have to undertake this project. So even if it's having a negative cash flow or a negative net present value. Okay, now the second part of the question is related to capital rationing. Calculate the maximum net present value which can be obtained from investing the fund of $10 million, assuming here that the nominal after tax NPV of project E is 0. So here they have assumed that, suppose that you are undertaking project E and it has a 0 NPV, though it was not. But for this part, they have asked us to assume that the project's NPV is 0. And what we have to do is to find out the maximum net present value, assuming that the company has only $10 million of funds. And we have to calculate how much maximum NPV the company can earn with these funds. So it's a capital rationing question where we have a restriction on our capital's availability, right? So remember, we can't invest more than $10 million. So now what to do? So if you remember in the start, the question mentioned that the projects are divisible. And that's a very important thing to note down in a capital rationing question. If the projects are divisible, it means that we can undertake a project either completely or partially. A non-divisible project is a project which we cannot have partially. Either we have to undertake the project completely or we have to leave it. So we can't have in parts. Like for example, if we are buying a car, we have the opportunity of buying a car, and let's say the car has a cost of say 20,000 US dollars, right? And if we have only $15,000, do you think we can buy part of the car? No, we cannot invest partially in such a car, right? Either we will undertake, or we will buy the car completely, or we will have to leave it. So that type of investment is called non-divisible. But here we can invest in the project. If we don't have a complete amount of investment required, we can invest in any proportion because these are divisible projects. Now for divisible projects, what we do is we do ranking. Remember, we do ranking. We rank projects. So part B will be, we'll take projects. Projects, we are going to undertake project E at any cost. So what projects are we left with? We have A, B, C, D, E, right? So A, B, C, D, and E. And we have a total of 10 million, that is $10,000 of investment available that we have to allocate between these projects, of which we have to undertake E at any cost, right? So we have to invest in E. And what was the amount of investment in E? 5 million, right? So we suppose that we have invested 5 million in E, now we are left with 5 million. And the rest of the 5 million will be invested in these projects. Right? So this is how we should go. Now I'm just removing the allocation of the resources. First, we have to go for the ranking of the project. So for the ranking, we have to pick initial investments first. So how much investment was required for each of these five projects? 2,500, 2,200, 2,600, 1,900, and 5 million. So I'm not including E at the moment. So these were the 4 projects. And then we should pick the net present value that we are going to get from each of these 4 projects. The net present values were 1 million, 1,550, 1,350, and 1,500. So these are the net present values that we are going to get. So now what we need to do is we need to calculate profitability index, PI, profitability index. What is profitability index? We are getting $1 million of NPV against the investment of $2,500, right? So we need to divide NPV by the amount of investment to see how much NPV we are getting by investing $1 of investment. So if we invest $1, how much are we going to earn? So better to write PI to 4 decimal places. So if it means that if we invest $1 in project A, we will be able to get $0.4 of NPV. Similarly, if we invest the same $1 in project B, we will be getting $0.7045 of NPV. And let's calculate all. So these are per dollar net present values. Right? So these are per dollar NPVs of each project. Okay, now my question to all of you is, if you have to choose one of these 4 projects, which one would you choose on top priority? The D. D should be on the top priority. So which 2 projects were mutually exclusive? B and D. So if you are going for D, then definitely we can't go for B. So B will now be eliminated as D is on the top priority. So there will be no B. Now can't invest. So B is no more there, right? because we have already decided that we should be going for D. Okay. From A and C, what should be the second ranked project? C. And then if we have in any investment left, we should go for A. So that's the ranking. And now let's allocate resources. Now let's allocate resources. First, we are going for D, then for C, and then for A. So how much is required for A? Yeah, definitely we are going to invest for E. So we can just assume that we have invested 5 million out of 10 million in E. So let us put that amount aside. Okay, so what is the amount of investment required for D? It's 1900, right? And we have 5 million of investment left. We have 5 million of investment left because 5 million have been invested in project E. So out of 5 million, 1900 should be invested in D. Okay, how much investment are we still left with? How much of the capital are we still left with? 3100. And how much is required for C? 2600. So we can easily go for 600 for C as well. Now we are left with we had 5 million of investment, of which we have invested 1900 in D and 2600 in C. So the leftover amount of investment will be $500,000, and this should be invested in A. This should be invested in A. Okay, now let's calculate NPV. Since we are going for D completely, therefore we'll be getting its complete NPV, right? We will be going for the complete project, and we'll be getting this complete amount of NPV, 1500. But the same can be calculated by using the profitability index. Look at this. We can calculate this 1500 by multiplying the investment into the per dollar NPV. Because if we invest $1, we get 0.7895. What if we are investing 1900? How much we are going to get? So we simply need to multiply and we'll get the same 1500 NPV again. And then we have to go for the project C. We are investing 2600, and each dollar investment gives us 0.5192. Just multiply it. It's 1350. And in case of A, we are just investing 500, and against $1 of investment, we are going to get 0.4. So multiplied with 0.4, and that's the NPV we are getting from project A. Asadullah, project D and B as per question cannot be undertaken together. Since project D has a higher profitability index compared with B, that's why we are taking project D. And once we have decided that we are going for project D, we cannot have project B. They are mutually exclusive. So this is what the NPV will be getting. And let's add all these NPVs together. And the total net present value that we will be getting from investing $5 million will be $3050. And that's our maximum NPV. Maruf, mutually exclusive means we can't go for these two projects together. Like if you toss a coin, you can't have head and tail at the same time. If you get head, you can't have tail. So these are two mutually exclusive things. They can't be together. So project D and B, they are mutually exclusive, which means that we can't have these two projects together. So that's the maximum net present value we can earn from investing $5 million. That's the ultimate answer of part B. So from 1 to 5, tell me how much did you get it? And it will be great if everybody participates in this feedback process. Okay, Anusha, I'm so sorry, Valentine, that you just gave me 2.5. Uh, you can ask me a question if you want to. And Anusha, we just simply need to multiply the amount of investment in A with the per dollar NPV that we'll be getting. We calculated previously that if we invest $1 in project A, we will be getting $0.4 of NPV. And if we are investing $500,000, how much NPV are we going to get? We just need to multiply with 0.4. Okay, okay, Valentine. But that was the problem with the management, not with me. You have rated me as 2.5. So that's the management's decision that they have restricted themselves up to a $10 million investment. So you can ask me the reason why a management would like to restrict itself to a particular level of investment. Should I explain the reason why a management will restrict itself to a certain level of investment? You know, there are multiple reasons why a management will restrict itself to a certain level of investment. Number one, if it wants to invest more, it has to either issue new shares to get equity finance, and if it does so, it will have to make new partners in the company, and it will dilute their voting power, which they may not want to. Secondly, the other way is to get a loan, a bank loan. In that case, they will be increasing their financial gearing, which will increase their risk, and they may not be willing to do that. So these are the two reasons why a management would not want to invest more. The third reason might be they don't want to expand, because expansion needs more management. It requires management, and sometimes the companies, they don't want to expand beyond a certain level because they may fall into trap. They may not be able to govern the company of such a huge size. So that's why they may not want to expand further. Yes, economic conditions may be the other factor because they may not be certain of what is going to happen, so they don't want to invest more. I hope, Valentine, it's clear now. So let's move forward then. And just a quick answer from all of you. How many of you want a quick 5 minutes break? Okay. Okay, let's take a 5 minutes break, just a 5 minutes break so that everybody gets refreshed, and we'll start um, solving sensitivity analysis and also lease or buy. Just a 5 minutes break. So back guys, and now let's start discussing lease or buy. So I hope you people are with me. Okay, now before I start lease or buy, let me quickly go through the background of lease or buy decision, right? A lease or buy decision is a financing decision, remember. It's a purely financing decision, whether you want to buy the asset by purchasing it outrightly and paying all at point zero, or you want to acquire the asset through a lease option, right? So that's a financing option. You are very much sure that you are going to acquire the asset, but the only problem is that you are deciding whether you should lease it or you should buy it, right? So it's a financing decision. Now, the problem when we are solving the lease or buy decision question will be which cash flows we should consider while taking this decision. Remember the concept of relevant cash flows concept. We should pick up the relevant cash flows, and the relevant cash flows will be the cash flows that will be affected by our lease or buy decision. For example, I'll just quickly ask you people questions and you have to respond, right? Will the initial investment differ in case of lease and buy options? Yes, it will be different. So whoever is saying no, just correct yourself. Yes, it will be different because in case of buying the asset, we have to pay at point zero. The whole amount of the asset will be paid at point zero. Whereas in case of leasing, we have to pay the lease rentals annually. So we are not required to pay the whole amount at point zero in case of lease. So the cash flows will be different. So remember, initial investment and lease rentals will always be relevant, right? So we must consider these two types of cash flows while taking the decision of lease or buy. Okay, what about scrap value? Will there be any difference to scrap value? Yes, yes, there will be a difference. In case of leasing the asset, remember the legal title will not be with you. You won't be considered as the owner of the asset. You are just using the asset. That's it. So in case of a lease, the company will not be able to sell the asset at the end of the useful life, and therefore it won't be getting any scrap value. But in case of buying the asset, since you will be owning the asset, therefore you'll be getting the scrap value as well. So it means in both the options, you don't have the scrap values. So in one of the options, you will have the scrap value, whereas in the other option, you will not have the scrap value. So it's a relevant cash flow. So scrap value is relevant. And remember, it should only be shown in the buying decision. Okay, another question. What about tax benefit on capital allowance? Should it be a relevant cash flow or not? Tax benefit on capital allowance will always be a relevant cash flow because this will only be available in case of buying the asset. Tax authorities will never ever allow you any tax benefit on capital allowance if you are leasing the asset. They only allow capital allowance on assets that you have purchased. So they won't allow any tax benefit on capital allowance, right? So tax benefit on capital allowance should only be shown in the buying option and should not be shown in the leasing option. So that's why it's a relevant cash flow. We cannot ignore it. Okay, what about tax benefits on lease rentals? Right? It's a relevant cash flow because you won't have any lease rentals in case of buying. So obviously then there will be no tax benefit available on lease rentals in case of buying the asset. But the tax benefit on lease rentals will be available in case of leasing the asset. Right? So when you are leasing the asset, you will have to pay rentals of the against the lease. And lease rentals are tax allowable expenditure. So when you will deduct lease rentals from your taxable liability, or sorry, taxable income, it will reduce your tax liability, and that is going to be a benefit. But that will only be available in case of lease. Okay, what about maintenance cost? Maintenance cost and its tax benefit. There is a condition. There is a condition. In case of maintenance cost, you have to look at the question. If maintenance cost is to be borne by the user of the asset, irrespective whether he owns or he has leased the asset, in that case, it will be irrelevant. For example, if I buy the asset, definitely the maintenance cost will be borne by me. But sometimes, even in the lease case, the lease agreement may state that the maintenance cost will be borne by the person who is using the asset. So it means whether I buy the asset or I lease the asset, in both cases, I have to bear the maintenance cost. So my decision is not going to change my maintenance cost, therefore it should be considered as irrelevant. So maintenance cost will only be relevant if it's there in one option, but it's not there in the second option, then it should always be considered as relevant. Right? So all these cash flows. So you can take a screenshot and keep it with you, because when you'll be solving a question on lease or buy, these are the relevant cash flows. Now, there may be other cash flows as well. So we cannot have a list that covers all the expenditures, but there is a simple principle that you need to remember. Every cash flow that we have to show in all options will be irrelevant. And a cash flow that is to be shown in one option but not in the other will be a relevant cash flow and must be considered. That's the only principle behind calling any cash flow as relevant or irrelevant. Let me explain it this way. Let's say we have an expense of $5,000 that we have to pay, and we have to pay this in both buying option and the lease option. In both cases, we have to pay this expense. So will this change our decision? Will this expense change our decision? So now we have two ways of treating this cash flow. Either we should show these two cash flows in both cases, so the impact will be zero because the difference will be zero. It's better not to show in either of the two options. Again, the impact will be zero, but it will save our time because we won't be considering it at all. So if any cash flow that is going to be any expense that will be borne in both the cases, that expense should be treated as irrelevant. But if there is an expense that will be borne by the company in one option, say buy, and no cost in case of the lease, then this should be considered as a relevant cash flow and should be shown in case of evaluating the buying option. Right? So let's start this question of AGD company. The font size is a bit small, but just excuse me with this. AGD company is a profitable company which is considering the purchase of a machine costing $320,000. If purchased, AGD company would incur annual maintenance cost of $25,000. And now since it's saying that if you buy this asset, you have to bear the maintenance cost, right? So this maintenance cost will be irrelevant if in case of lease, even we have to bear this cost, then it will be irrelevant. But if in case of lease, we don't have to pay this cost of maintenance, then it will be relevant. The machine would be used for 3 years, and at the end of the period, this will be sold for 50,000. Alternatively, the machine could be obtained under an operating lease for an annual lease rental of $120,000 per year, payable in advance. Okay. And the tax allowable depreciation is 25%, reducing balance, and tax is paid at the rate of 30%, and the tax is paid in arrears. And AGD company has an accounting year that ends on 31st December. Okay. If the machine is purchased, payment will be made in January of the first year of operation. If leased, annual lease rental will be paid in January of each year of operation. Borrowing rate is 7%, and we should evaluate whether we should buy the asset or not. So let's start with the buying option first. What will be the net present value if we buy this asset? 0, 1, 2, 3, 4, and what was the life of the asset? The lease term was 3 years. Okay, because of the arrears, we have to expand it to year 4 as well, right? Because of the tax in arrears, right? Okay, now first of all, we should take initial investment because it is a relevant cash flow and should be shown at 0.0, and that's 320,000. Okay, then we have scrap value and should also be shown as it's a relevant cash flow and should only be shown in case of buying the asset, and the scrap value is $50,000 and should be positive. Okay, after that we have a tax benefit on capital allowance, and it's available on reducing balance basis, so we can use the shortcut. Okay, we can use the shortcut since the asset will be purchased at the start of the first year, right? But the first tax liability will be calculated at the end of the first year, because tax liability is always calculated at the end of the year. tax liability is always calculated at the end of the year. But because of the tax being paid in arrears, the first tax benefit should be shown from year 2 and then will be shown onwards. So it should start from year 2, right? And we can use that shortcut. What was the cost of the asset? It's 320,000, and the reducing balance basis rate is 25%. We should take 25% of this figure and should multiply it with the tax rate, and the tax rate is 30%. We have started from year 2 because the tax is being paid in arrears. Imasha, is that clear? Because of arrears, the tax benefit should be shown, the first tax benefit should be shown from year 2 onwards. Ashar, why isn't it clear? Yes, yes, we are purchasing the asset at the start of the year, right? But we do not, we never pay tax at the start of the year, because whenever our tax liability will be calculated for that year, it should always be at the end of the year. So the tax liability will be calculated at the end of the tax year, and once it is calculated, then it will be paid. So if it says that you have to pay tax in arrears, that means it should be after 1 year the tax liability is calculated. Right? So it should start from year 2. So cost of the asset multiplied by 25%, that will give us the capital allowance figure, and multiplied by the tax rate to get the tax benefit, 24,000. So what should I do for the second year? Who's going to tell me? For the third year, what should I do for the third year? Everyone. Yes, I should reduce it by 25%, or I should take 75% of the previous year tax benefit. Excellent. Okay, it's going to be 18,000. So 2 years are gone. In the third year, which is the last year, we should apply a different formula, and that is the cost of asset depreciated by 25% for 2 years, 75% raised to the power 2. So if I depreciate it at the rate of 25%, I'll get the net present, I will get the WDV after second year. Right? And then from this, I have to subtract scrap value, which is 50,000, and then multiply it with the tax rate to get the balancing tax benefit on balancing allowance for the last year. It's 39,000. The tax rate is 30%, not 28%, Nadeem. It's 30% in this case. So don't make this mistake in the exams. So here we go, we have got tax benefits as well. Now comes the maintenance cost. Maintenance cost. Maintenance cost will be at the end of each year. So 25,000, 25,000, and 25,000. right? So there should also be tax benefit related to maintenance cost. Because of maintenance cost, our tax liability will be reduced as it's a tax allowable expenditure. So on one hand, we will be paying $25,000 of maintenance cost and should be shown as negative figure. But on the other hand, we will be claiming this as a tax expense and it will be reducing our tax liability. So we should be showing it as a tax benefit as well. So, and that is going to start from year 2 because of the arrears. So we should take 30% of 25,000 as our tax benefit related to maintenance cost. So 7,500. The 7,500 is basically the reduction of the tax liability because of claiming this as an expense. And since every year's maintenance cost is same, so the tax benefits will also be same. Now I think we are done with all the costs. Let's now calculate net cash flows for each year. And then we should take discount factor at the rate of 7%, but the borrowing rate is 7% and we should make it after tax. But since it's already after tax, we don't need to do anything. But remember, it should always be after tax if we have considered tax benefits. If we have considered tax benefits, then the borrowing rate should always be after tax, which is after tax in this case as well, so we don't need to change. Okay, I've got a question from Nadeem, and he says that when we calculate discount factor using Excel, it will be different from the discount factors that we usually see in the table. Will that make any difference? It will not make any difference. It's better to use Excel, but if you want to use those factors from the table, it won't make any difference. Okay, Muhammad Abdul Rahman is saying that I think our tax benefit in year 4 is wrong. Okay, let me check. The cost of asset is 320,000, depreciated at 75% power 2. Is that? I don't think I think it has been correctly calculated. So you should check your own calculation, Abdul Rahman. It's a correct one. So we have a net present value, a negative net present value of buying the asset. Now remember, this should always be negative. So don't say because it's negative NPV, therefore we should not be buying the asset. Remember, it's not a buying or not buying decision. It's not an investing decision. It's a financing decision, and we are comparing costs of the two options: the cost of buying the asset and the cost of leasing the asset. And both options will have a negative NPV showing a cost figure. So if we buy the asset outright, this is going to be our net present value. But now let's check it out. What will happen if we go for a lease option? So for the lease option, I'll slightly change the format, and I like this format for leasing option 0 to 1. Sorry, at 0 to 1, because the lease rentals will start from advance, right? Will start in advance. So it means that the first payment of lease rental will be paid at 0.0. And when will be the last payment made? Everyone. If we pay the first payment at 0.0, then when are we going to make the last payment? Year 2, right? 0, 1, 2. There will be 3 payments in total. There will be 3 payments in total. The lease period is of 3 years. So if the first payment is made at 0.0, the second will be paid at 0.1, and then the last will be paid at 0.2. So 0 to 1. Okay. So we are talking about rentals. And what's the amount of rental? That's our cash flow. What's the amount of rental? 120,000 every year, right? And which factor should I use? Should it be discount factor or annuity factor? Yes, it should be annuity factor. It should be annuity factor. So now there are 2 ways of putting annuity factor here. One is using the table, and the other is using the annuity formula. So I'm using the annuity formula, but you can always use the annuity table to put in the factor, right? But the problem is our first annuity is starting from year 0, and you know the discount factor of year 0 is always equal to 1. Then we are left with 2 years, so we need to calculate the annuity factor for 2 years, and the formula is 1 minus 1 plus R, which is 7%. 1 minus 1 plus R is to the power 7 plus R raised to the power minus 2, and then it should be whole divided by the rate. So 2.808. Okay, let's calculate present value now. Okay, now since we don't have to pay any maintenance costs, so there will be no maintenance cost, no tax benefit on capital allowance, no scrap value, no initial investment. The only thing will be the tax benefit on these rentals, because lease rentals are also tax allowable. So now from which year the tax benefit will start from year 2. Excellent, excellent. From year 2, not from year 1, from year 2, ACCA, because we will be paying the first lease rental at the start of the year. But as I told you earlier, the liability of the tax will always be calculated at the end of the year. So the first year's liability will be calculated at the end of the first year, and because of arrear, we will be paying after 1 year. We'll be paying the tax after 1 year. So it's gonna start from year 2. So it's gonna start from year 2, and where will it end? Four. Excellent. And what are we talking about? We are talking about tax benefit on lease rentals, and the tax benefit of lease rental will be 120,000 into 30%. And the 120,000 should be shown as a negative figure because it's a cash outflow, whereas the lease tax benefit will be shown as a positive figure as it's a benefit, 36,000. Now what should be the annuity factor? So I'm not going for the formula for the annuity factor here, it will be complicated, so it's better we should use the table. So since the last tax benefit will be received at the end of year 4, so we should take annuity factor of the 4th year. But since it's starting from year 2, so we have to deduct the discount factor or annuity factor of year 1. So can anybody help me with this? Just if you have annuity table, just look for the 4th year annuity factor at 7% rate. Can anybody help me out with this? Just look at your annuity factor table and tell me the 4th year annuity factor at the rate of 7%. It's 3.170. Are you people sure? What is the annuity factor at 7% for year 4? 3.387. Okay, but that covers year 1 as well, and there is nothing, no tax benefit received. There is no tax benefit received in year 1, so we have to deduct the annuity factor of year 1, which will be 0.935. So we have to subtract 0.935 so that we are left with year 2, 3, and 4. So that's the applicable annuity factor, and let's multiply now. Right, and let's now net off these two figures, and that's called the net present value of leasing the asset. So if we lease the asset, it's going to cost us 248,690, and if we buy the asset, it is going to cost us 260,989. Which option is better? Since the cost of leasing the asset is lower than the cost of buying the NPV, therefore we should go for leasing. That's the answer. So we should go for leasing. Yes, Taha. Taha, I am waiting for your question. The 2.452 is basically the difference of year 4's annuity factor and year 1 annuity factor, because our tax benefits will start, we will start receiving our tax benefit from year 2 till year 4. Why should we be multiplying? We should be subtracting, because this 0.935 is added in this figure, whereas we don't need this year 1 annuity factor, so we have to subtract it. Or else you can do one thing, Taha, you can do one thing. Just add discount factors of year 2, 3, and 4. Taha, just add, forget about annuity factor, just add discount factor of year 2, 3, and 4, because we are going to receive tax benefit from year 2 to 4. Okay, let me make it simple for all of you, though it's a very basic concept, but let me do it for you. Let's calculate discount factors, right? Let's calculate discount factors. First, let's calculate discount factor for year 0. That's for year 0. And for year 1, it will be 1 plus 7% raised to the power minus 1. So that's for year 0, 1, 2, 3, 4. Power minus 2, power minus 3, and power minus 4. So here we go. We have got individual discount factors, right? So here we need for year 0, 1, and 2. So all I will do is I will just add the discount factor of year 0, 1, and then 2. So the same one, right? So in this case, we need year 2, 3, and 4. So we'll just pick 2, 3, and 4. That's it. So no change to the answer. I hope it's clear now. I can't simplify it more than this. So we are done with this. Yes, the comment will simply be that we should go for leasing the asset, as the cost of leasing asset is lower than the cost of buying the asset. Okay, let's move towards another topic, that's sensitivity analysis. But before I go to the sensitivity analysis, I'm just giving you people 10 minutes to solve this question, and then I'll get back to this question and solve it for you. Just try this question yourself. You have 10 minutes and your time starts now. So I hope you have tried this question, and now let's start doing it. First of all, before we do some calculations directly for sensitivity, first let's calculate net present value. So let's start with the sales figure first. What's the sales volume? What is the sales volume every year? 20,000. Okay. What's the tax rate? Sorry, what's the selling price? 3. So the total sales revenue will be 20,000. 60,000. And that's every year, right? Okay. And that will continue for 5 years. So, and it will be NVT. So we can take NVT factor. We can take NVT factor, and then we will calculate present value. So that's NVT factor, and NVT factor should be for 5 years, right? So let's calculate the NVT factor. 1 minus 1 plus, what's the rate? 12%. Raised to the power minus 5, as it is going to be for 5 years, and divided by 12%. That's NVT factor. It's not working. Okay, let's calculate the present value of sales revenue. Then comes variable cost, which will be for the same sales volume, and 1.65 is the per unit variable cost. And let me write it in as a negative figure. And NVT factor will be the same, and same formula here. Then comes contribution. Present value of contribution should also be calculated. Then we have fixed cost? And what's the fixed cost? It's $10,000 per year with the same NVT factor. That's present value. So the profit will be so that's the profit, and from this we need to subtract the investment at the end. Investment is 50,000, and the net present value will be that's net present value. Okay, Orlando, what's wrong with the sales figure? I don't think there is anything wrong with the sales figure. That's the sales revenue per year. Then we have multiplied it with the NVT factor, and we have got the present value. So should we undertake this project or not? Right? But that's not the question. This is not the question is looking for, right? But yes, we are going to accept this project because of the positive NPV, and we will accept it till it stays positive. Till it stays positive. But tell me one thing, if I change the sales volume, will this change the NPV? If I, Asad, by multiplying it with the NVT figure, we have actually calculated it for 5 years. So if the sales volume goes down, what will be the impact on NPV? Increase or decrease? Decrease, right? Yep, it will decrease. If the sales volume goes down, if the sales volume goes down, it will reduce your net present value because your income will be reduced, and as a result your net present value will be reduced, right? Okay, since all this is being done because for future, therefore we will not be certain whether we will be getting this sales volume or not, and the sales volume may change in the future, and we are concerned about the fall in the sales volume. We are concerned about the fall in the sales volume, but we want to check how much decrease in this sales volume we can afford. We can only afford the change that will result in zero NPV, not more than that. So how are we going to find it in terms of percentage? If we find out the percentage decrease in sales volume that will result in zero NPV, that percentage is called sensitivity of the projects towards sales volume. So the formula of calculating sensitivity percentage is always equal to NPV divided by present value of project variable. So let me first calculate it for selling price. Let's check it out how much decrease we can afford in our selling price. And after some few calculations, I will explain the importance of these calculations. So the NPV is 11281, and since we are looking for the price change, therefore we should divide it by the present value of the sales revenue. In order to check the sensitivity of the project towards the selling price, we should always divide NPV by the present value of sales revenue, remember, and the resulting answer should always be reported in percentage. So it says if the sales volume, if the selling price is reduced by 5.22%, the NPV will be 0. Let's check it out. At the moment the price is $3, and let me reduce it by 5.22%. Right? Let me reduce it by 5.22%. So 0.0522. See, the NPV is approximately 0. Since that 5.22% was not the exact figure, it was rounded off to 2 decimal places. Therefore, we still have a slightly negative NPV. But we can say we have a 0 NPV. So if the price goes down to 2.8434, the NPV will be 0, which is a 5.22% change. So we cannot change, we cannot afford a change beyond this level. So let's get back to the original value. So this 5.22% is telling us that your price, if the price goes down by 5.22%, your NPV will be 0, and you cannot afford a further decrease in your price. That's the maximum fall in the price that we can afford. Maximum fall in price. You can't afford more change in this price. And let's calculate it with variable cost as well. For variable cost, we will again pick the NPV, but we have to divide it by the variable cost, present value of variable cost, and it's 9.48%. So we can say that your variable costs may increase, but it should not increase more than 9.48%. That's the maximum increase in variable cost. Let's try and increase the variable cost by 9.48%. Let me increase it by 9.48%. The NPV is just $4, which is equal to 0. So if our variable cost increases from $1.65 per unit to 1.80642, our net present value will be 0, and we won't be saving anything, and any change above this will result in a negative NPV, which we cannot afford. Now let's check it with sales volume. But you know that sales volume, if sales volume falls, it will not only affect your revenue, it will also affect your variable cost as well. Therefore, we should always pick up the contribution figure for checking the sensitivity with the sales volume. So we'll pick the NPV like we did earlier, but we will divide it by the contribution, the present value of the contribution figure. Neither the sales, neither revenue, nor the variable cost. It should be the net of these two to check with the sales volume. So the maximum fall in sales volume should be 11.59%. Any fall beyond this level will be resulting in a negative NPV. Let's check it for our own sake. Let's decrease our sales volume by 11.59% and see if it results in a 0 NPV. 1 minus 1 minus 0.1159. Here we go. We have ended up with 0 NPV. So if the sales volume falls below this percentage of sensitivity, that is 11.59%, we will be ending up with a negative NPV. Okay, let me repeat it for sales volume. For sales volume, we should pick the NPV, that's the NPV figure, and divide it by the present value of the contribution figure. That's the contribution figure, right? This one, the present value of the contribution. And that's the sensitivity with regards to sales volume. Okay, We can also check it with fixed cost, though the question hasn't asked us to calculate it with fixed cost, but we can also calculate the sensitivity with fixed cost. And in that case, we will pick NPV and divide it by the present value of the fixed cost, which is 36047.76. And this is 31.3%. So the increase in fixed cost, the maximum increase in the fixed cost that we can afford is 31.3%. So if we increase this figure of $10,000 by 31.3%, our NPV will be zero. Let's check it again. $1.313. Let's do it. It should be as a minus figure, right? So again, here we go. Our NPV is almost equal to zero. So increasing the fixed cost by 31.3% resulted in a zero NPV. Right? And let's do one thing more, and that's for the cost of capital. So how much change we can afford in our cost of capital? Now, for checking the sensitivity of the project with the cost of capital, we have to do some additional calculation. We have to calculate IRR first, because we all know that IRR is the rate at which NPV will be zero. So I'm not going for calculating the IRR at the moment, as you all know how to calculate IRR. So what we should do after calculating IRR, that is more important. So let me just assume that we have the IRR figure for this project, and that I'm just assuming, okay? So let's assume that we have calculated IRR, and this IRR is basically 18%. I'm just assuming. I'm assuming that if we increase our cost of capital from 12% to 18%, the NPV will be zero. So it means that we can only afford our cost of capital up to 18%, which it currently is 12%. So if the cost of capital is 12% and the project NPV gets zero at 18%, it means the maximum change that we can afford is 6 percentage points in this figure. Right? We can only afford 6 percentage points increase in our cost of capital. Abdul Rahman, I haven't calculated IRR. I have just assumed IRR to be 18%. You people can later on calculate IRR yourself, because it will take some time for me to calculate the IRR. So just assume that the project IRR is 18%, right? Just assume that it's 18%. Just assume that it's 18%. The current cost of capital is 12%. Kali, don't worry, even if it's 21%. Just for the simplicity's sake, I have assumed it to be 18%. It will make everybody understand easily. No. Don't assume in the exam, Krishna. Don't assume it in the exam. In the exams, you have to calculate IRR. I wanted to save the time, but it's still going. So I was just trying to save you people time. So assume that the cost of capital, the IRR is 18%, and cost of capital, which is 12% in this case. What does these two figures tell us? These two figures tell us that if our cost of capital increases from 12% to 18%, our NPV will be 0, which means that this is the maximum change that we can afford in our cost of capital. And that change is basically 6 percentage points. So that's 6 percentage points, right? 6 percentage points. So if the cost of capital is 12 and the maximum change in this cost capital that we can afford is 6, then what is it in terms of percentage? So we'll divide it by 12. We can afford a 6 points change in our cost of capital, which is equal to 50%. So we can say if our cost of capital increases by 50%, the NPV will be equal to 0, and that's called sensitivity of the project towards its cost of capital. Now, most of the students, what mistake they will make if they are asked to calculate sensitivity, what they will do is they will calculate IRR and they will just simply compare it with the 12% and say that the change is 6%. And they will call this 6% as the sensitivity percentage, which is the wrong way of doing it. It's not 6%, it's 6 percentage points. If 12 increases by 6, it means there's a 50% change in this cost of capital, not 6%. So remember, don't do this mistake. So just take the difference of these two and divide it by 12 and multiply it by 100 to convert the change into percentage. Is that clear? Okay, again, I would like you people to give me a rating from 1 to 5 for the session that has been conducted so far. Okay, thank you very much, everyone. So we are done with sensitivity, we are done with the lease or buy, we are done with NPV, IRR, and now let's move towards our day 2. Sorry, day 3. Day 1, we are done with day 1. Let's move towards 3. Okay, we are starting with cost of capital. So far we have just used cost of capital. And now we will be learning how to calculate cost of capital. So we have a question, comprehensive question. With the name of cap company, but before I solve it, I will just give you 10 minutes to solve this question, and then I'll solve both part A and part B for all of you. So just take a screenshot in case you don't have these handouts, though these worksheets are there in the Google Classroom. So you may download it from there. I'm just going to share the link to Google Classroom on the WhatsApp group. And I'm sorry if I haven't added any one of you so far. I will just add because there were so many students that I had to add. So I will add the rest of you as well. Sharing the link again. Meanwhile, you should start taking screenshot of the question. Let me know once it's done. So start solving part A and part B. Okay, I hope you people have tried it. Now let's solve it. Now, first of all, the requirement says that we need to use CAPM model to calculate the required return on equity. Now, how do we calculate cost of equity using the CAPM model? Cost of equity is basically the overall return that we are giving to our equity holders. And using the CAPM model, how we calculate it, we just pick the risk-free return, RF, which is the risk-free return, that is investment in securities that bear no risk. Usually the government investments, the treasury investments. RF into equity beta multiplied by RM market return minus RF. I'll just explain while we will be calculating it. So let's go through the requirement again and understand what they are actually up to. Using the CAPM pricing model, calculate the required rate of return on equity of CAPM at 30th September 2002. Ignore any impact from the new campsite project. That's important. Briefly explain the implication of a beta of less than 1, such as that of cap company. So we need to explain this less than beta concept as well, but let's first calculate the cost of equity using the CAPM model. First of all, we have to see what is the return available for risk-free investments. And the risk-free investments, these treasury bills, these investments are usually in practically, if we talk about any investment that is risk-free, we won't find any investment that is completely risk-free. But theoretically, government investments, government securities are considered to be risk-free, and treasury bills are one of them. So 5% is the risk-free return. That is, if you are investing in a government security which has no risk of default, you will be getting 5%, right? So if you invest anywhere else, this is the minimum that you will be expecting, because if you can get 55%, if you can get 5% without taking risk, then definitely with risk, you will always ask for more. Okay, that's 5% plus the equity beta. So the equity beta of the cap companies is 0.8. Now, what does this mean? Just understand the concept of equity beta so that you can interpret this figure if it's asked in the exams. A 0.8 equity beta or any other equity beta, what does that show? Equity beta is actually the relative risk of a company's investment compared with the average risk of the market. So what does that mean? Let's say if our company responds to the market shares in such a way that, let's say, if the share price of the market goes, the average share price of the market goes up by 10%, and our share price goes up by 15% as a response of the overall change in the market, it means we are 1.5 times more volatile than the average market. Similarly, if the share price will go down, our share price will go down 1.5 times of what is happening in the overall market. So our equity beta will be 1.5, showing that we are 1.5 times as riskier as the average market is. In case of a CAPM company, its equity beta is 0.8. So what does this tell you? Is cap company more riskier than the average market or less riskier than the average market? Yes. More than one suggests that it is more riskier than the market, and less than one suggests that it is less riskier than the market. And this is what the explanation was required in the question, right? So let me remove this and let's go back to the question again and let's calculate the equity beta. The risk-free return is 5% plus equity beta, which is 0.8, and the market return, average market return is the financial market expect an average annual return of 15%. And from this, we need to subtract the risk-free return. Now, let me explain the whole concept now. The financial market expects an average return of 15%, right? This is the average return that we expect from the market, not from the company. We expect this from the market, 15%. Now, if we invest anywhere in a government security, we expect 5%. From this market, we expect 15%. So anyone, do you people know why we are expecting a higher return from this market as compared to a government security? The reason why we are expecting a higher return. Because of the risk involved, right? So it means we are looking for a premium against the risk, and that's called risk premium. So the risk premium in this case is 10%. That's called risk premium. But this risk premium is expected from the average market, not from the company. That's what we expect from this market to generate a return in addition to the risk-free return, 10%. That's called risk premium, right? Now, what about the cap company? Is the cap company more riskier than the market or less riskier than the market? It's less risky than the market, right? So should we expect the same risk premium or less risk premium? Less, right? And equity beta suggests it should be 0.8. So we should expect 0.8 of the risk premium, which is 8%. So from cap company, the risk premium of cap company will be 8%. So anybody investing in cap company will be asking for 8% risk premium, whereas the average premium from this market will be 10%, right? But that's not the overall return that we will be looking from the cap company. It's the risk premium. It's the additional return that we will be expecting. And what is the minimum return that we will be expecting? 5%, right? Okay, what will be the overall return then? 5% plus this 8%. That's the 13% return that we will be expecting from cap company, and this is called your cost of equity using CAPM model. I've used the same formula to calculate this 13%. Now let me directly calculate it with the help of formula. The formula says it should be the risk-free return, that's 5%, equity beta, which is 0.8, into market return, which is 15%, minus the risk-free return, which is 5%. So if we just put it in the formula, we'll get the same figure. That's 13%. I hope it's clear now. Okay, what was the second part, the B part? Yes, You will get formula tables, but not for every formula in FM. So you can check for ACCA website where you can find the formula sheet, and that will tell you which formulas will be available in the exams. In this case, 2 or 3 lines would have been enough. Okay, what was part B? The part B says we need to calculate the weighted average cost of capital, right? So for calculating the weighted average cost of capital, we need to calculate cost of debt as well, because we have already calculated cost of equity. Now we need to calculate cost of debt. So for that, first of all, we need to identify which types of debts do we have. How many types of debts do we have in the question? 2 types of debts, right? And we have to calculate cost of debt for these 2 separately, right? For these 2 types of debts separately. So first of all, let's calculate the cost of debt of the irredeemable preference shares. Cost of debt of irredeemable preference shares. Now, watch it carefully. What's the interest rate on irredeemable preference shares? The coupon rate or the interest rate? Remember, coupon rate and interest rate, they both are same. And they're always written here, 9%. And remember one thing, this percentage is always applicable on the nominal value which is written here, right? So each investor will get 9% of par value, which is $1 on each share, right? On each share. So 9% into $1. That's your dividend per share. This is something that you need to calculate first. This is what we are paying to our investors. Since these shares are irredeemable, it means that the investors will keep on getting this amount per share every year, and they won't get anything else. This is the only return that they will be getting, 0.09. Okay. Are dividends tax allowable? Never. So there should be no impact of tax, remember. So we should not incorporate tax in this. Okay. So every investor is going to get $9, $0.09 per share dividend. Okay. What's the market price of each share? The market price per preference shares was $0.9. $0.9. It means that any investor who buys this share today will invest $0.9 in this company. And against the $0.9, the investor will be paid 0.09, which is 10%. Simple. And that's called cost of debt of the preference share. So every investor who invests today will be investing $0.9 for every share. And against this $0.9, the investor is going to be paid $0.09, which is 10% of the investment. And that is called cost of debt of the company. Is that clear? A share preference shares, the dividend on preference shares, they don't grow. It's a preference share, and the investors will be receiving at a constant dividend every year. Yes, Orlando, your question is a very good question. For all irredeemable debts, you have to use this approach, but the only difference is if it's not a preference shares and if it is any other debt instrument, then it should be after tax. You should subtract the tax. That's the only difference. Interest should be first adjusted with tax rate and then should be divided by the market value. That's the only difference between irredeemable preference shares or irredeemable debt. Okay, let's move forward now. Now we have 8% loan notes and that will be redeemed in 2003, right? No. When are these loan notes going to be redeemed? Okay, the loan notes are redeemable on 30th September 2003. And what's our year end at the moment? It's 30th September 2002. So after how many years it is going to be redeemed? After 1 year. So it makes our calculation very easy now. Otherwise, we would have been going through that IRR procedure to find out the cost of debt. Here, it's going to be very simple. Now, it's going to be very simple. If anybody who subscribes our loan note today, how much they have to invest per loan note? What's the current market price of a loan note? What's the current market price of the loan note? 100.57, right? So anyone who is going to buy our loan note, they will be investing 100.57 for each loan note. Okay. So current market price will be 100.57 dollars. Okay, fine. And after 1 year, what this investor is going to get against this investment? So after 1 year, it is going to be redeemed at what price? If nothing is mentioned, it will always be redeemed at par. And what's the par value? $100. So is there a gain for the investor or a loss for the investor? A loss of 0.57, loss of 57 on redemption. Okay, but will the investor get any interest during this 1 year? And what's that? It's 8%, right? Okay, the interest will be 8%. 8% of what? of par value. It should always be par value, and it should be made after tax as well. The tax rate is 30%. So we should take 70%. Okay, the per $100 interest will be 5.6 after tax, right? It's $5.6 per $100. Okay, what will be the net return? What will be the net return for this company? The net return for this company will be 0.57 and difference of 5.6 and 0.57, right? Because on one hand it earned an interest of 5.6, on the other hand it lost $0.57 in its investment value. So it's $5.03 of net earning. And this net earning is against a total investment value of 10057. So if we want to convert it into percentage, what we need to do is we should divide the earning by the amount of investment. And in the percentage form, it is going to be 5%, and that's called cost of debt. This is simple because it was redeemed in just 1 year time. Otherwise, we would have gone through the IRR procedure for calculating the cost of debt. So the total earning of this individual is 5.03 against $100.57 of investment. So this is the return for the investor, but cost for the company. So the investor would say, I earned 5%, whereas the company will say, we paid 5%. So it's a cost for the company. Is that clear? Thomas, this investor lost $0.57 on redemption because this investor will invest 100.57 and will just get $100 in 1 year's time, which is a loss of $0.57. But on the other hand, it earned after tax interest of $5.6. So the total earning will be 5.6 minus 0.57, which is 5.03. And that earning is against the investment of 100.57. So if you want to convert it into percentage, we have to divide it by the market price, which is 100.57. Hamza, we are not calculating the market price, so we don't need to calculate the present value. We are calculating the return for 1 year. This investor earned $5.03 and invested $100.57. So the return that this investor got is 5.03 divided by $100.57. That's it. So we don't need to calculate present value. So okay, let me give you a quick recap. Right, we are just left with 5 minutes, and I also have to calculate the weighted average cost of capital. We are only left with 5 minutes, so I have no urgency now. I can give you a quick recap of what we did, and I will leave you people to calculate the weighted average cost of capital as your home assignment, and I will solve this and I will calculate this weighted average cost of capital in the next session. But let me give you a quick recap of this cost of debt. Basically, just think from the investor's point of view. This investor will invest $100.57 today. After 1 year, he will be given his investment back, but only $100. So there is a loss of $0.57 to this investor. $0.57 loss to this investor. But at the same time, after 1 year, this investor is also going to get interest, which is 8%. And it's 8% of the $100 par value, which will be $8. And we need to make it after tax as it is interest. So we just took 7% of it. So we can say the investor earned $5.6 after tax on one hand, and on the other hand, it lost $0.57. Then the net earning will be 5.6 minus the loss. It's 5.03. And how much the investor invested? It was $100, 100.57. So the return in the form of percentage will be 5.03. That is the net return divided by the investment, which is 5%. That's the cost of debt. Is that clear now? Okay. So I'm done with today's session, and we will continue with the cost of capital tomorrow, and we will also discuss sources of finance tomorrow. And day after tomorrow, we will be discussing business valuation and risk management. And probably we will also start business valuation, some part of business valuation tomorrow as well. Yes, Farheen, I will share questions on Google Classroom for practice sake. Now, just need a quick rating for the whole session of today. I have more students in the session, so if it will be great if you people give me this rating. This is a feedback for me, and if you feel it should be less, don't worry. I welcome any type of feedback. It's always good for my improvement. Anyone who hasn't been added to the WhatsApp group yet should send me a message on the WhatsApp. Wasim, we have already done what we were supposed to be doing on day 3. So we are going at a very good pace. Maruk, you said it was really good from previous ones. Can you just tell me the previous ones? What do you mean by previous ones? My same sessions, previous sessions, or you're comparing with someone else? Okay. Yeah, yesterday, I don't know. I was feeling so down, as I told you that I had health issues yesterday, and I was not giving my 100%. Tomorrow we will be continuing with cost of capital, and we will also discuss source of finance, and probably we will start business valuation as well. Okay, thank you very much, everyone, and see you people tomorrow. Have a good day.